Good day. Hi, my name is Jeffrey Squeta, BSMA, BSIS 1. Okay, I'm here to discuss the Pfrs 9 or the Philippine Financial Reporting Standards 9 financial instrument. Okay, first, Pfrs 9 is entitled Financial Instruments. This is a standard that governs financial instruments. And also, Pfrs 9 has been developed by the IASB to replace PAS 39. And financial instruments recognition and measurement. Okay, we will go to the. We should know the learning objectives of PFRS 9. First, state the classifications of financial assets and their initial and subsequent measurements. Number 2, state the classifications of financial assets and their initial and subsequent measurements. Okay, before we go to the introduction, ano nga ba yung financial instruments? Siyempre, para maliwanagan kayo, financial instruments, ito yung any contract. Okay, take note. Yung contract, siyempre, so two parties should involve in that contract that give rise to financial assets of one entity and a financial liability or equity instruments of another entity. In these financial instruments, there are two entity. The first one is to give rise to a financial assets, and the second entity is to give rise to a financial liability or equity instruments. Okay, let's go now to the introduction. PFRS 9 establishes the financial reporting principles of financial assets and financial liabilities, particularly their classifications and measurement. PFRS 9 applies also to all financial instruments except those that are dealt with under other standards, such as interest in subsidiaries, PFRS 10 consolidated financial statements, associates and joint ventures, PAS 28, and also those arising from employee benefit plans is PAS 19, leases, PFRS 16, leases, and shared-based payment transactions, PFRS 2. Those that are required to be classified as equity instruments, PAS 32, and those arising from contract within the customers that are specifically accounted for under PFRS 15 revenue from contract with customers. Okay, we'll go now to the initial recognition of financial instrument. Financial assets and financial liabilities are recognized only when the entity becomes a party to a contractual provisions of the instrument. Okay, before that, ano nga ba ang financial assets? Ang financial assets, isa siyang cash, and also it is a contractual right that to receive cash, to exchange financial assets, liabilities, and also this is a potentially favorable. Next, what is financial liabilities? Financial liabilities naman, this is a contractual obligation word is to deliver cash. Kung kanina yung assets, yung financial assets is to receive cash and to exchange. This one is to deliver cash and also to exchange cash. And this is a potentially unfavorable. The third one is the equity instrument. Equity instrument, ito yung any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. It's just a residual interest. Talk about the residual interest. Okay. Classification of financial assets. Financial assets are classified as subsequently measured at amortized cost. Next is fair value through other comprehensive income and fair value through profit or loss. Amortized cost. Amortized cost, ito yung kumbaga, is that accumulated portion of the recorded cost of a fixed asset. Kumbaga, ito yung sisingilin sa gastos sa pamamagitan ng alinman depreciation or amortization. Next. We'll go now to the basis of classification. Financial assets, except those that are designated, are classified on basis of both the entity business models for managing the financial assets and the contractual cash flow characteristic of financial assets. Next, classification of amortized cost. A financial assets is measured at amortized cost if both of the following conditions are met. The first one is the asset is held within a business model. Those objective is to hold financial assets in order to collect contractual cash flows, or it's also called hold to collect the business model. Kumbaga, ang objective nitong assets is to hold the financial assets in order to collect the contractual or the cash flow para sa business models. Letter B. The contractual terms of the financial assets give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. Okay. Dito naman, ginagamit nila yung solely payments of principal interest para sa contractual terms of the financial assets. Next. Classification at fair value through other comprehensive income. Letter A. Financial assets is measured at fair value through other comprehensive income of Pfrs. If both of the following conditions are met, letter A, the financial assets is held within the business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. And dito naman sa fair value through other comprehensive income, the financial assets, ang objective naman niya is to achieve both collecting and selling. Kung kanina, yung sa amortized cost is collecting lang ng cash flows and contractual cash. Dito naman is both collecting and selling of contractual cash flow na financial assets. Hold to collect and sell business model. Letter B. The contractual terms of the financial assets give rise on the specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. So, katulad lang din ng kanina, ginamitan din nila ng solely payments of principal and interest, or SPPI. Next, the classification at fair value through profit or loss. A financial assets that does not meet the conditions for measurement at amortized cost or Pfrs is measured at fair value through profit or loss. Ang sabi dito, kung yung financial asset hindi niya na-meet yung condition na amortized cost or yung Pfrs or the fair value of other comprehensive income, i-measure siya through fair value through profit or loss. This is normally the case for held for trading securities. Yun. Para yun sa held for trading securities. Next. Exceptions. Number 1. Investments in equity instruments at Pfrs. An entity make an irrevocable election of initial recognition to classify an investment in equity instruments. Okay, in this, gumawa sila ng irrevocable election at initial recognition to classify the investment in equity instruments. So, that is na neither held for trading or contingent consideration in a business. Combination as fair value of other comprehensive income even if it would otherwise be measured at fair value through profit or loss. Next, number 2, option to designate a financial asset at fair value through profit or loss, or FVPL. An entity may irrevocably designate a financial assets at initial recognition as measured at fair value through profit or loss. Okay. If doing so eliminates or significantly reduces a measurement inconsistency, accounting mismatch that arises when assets and liabilities or gains and losses are measured on different bases. So, ang tawag sa kapag daw yung assets and liabilities or gains and losses is na measured siya in different bases, it will call the accounting mismatch. Next, remember the following. Basis of classification. The first one, the business model. Business model is to hold to collect cash flow characteristics, SPPI, or example given, debt instrument. Okay, classification is amortized cost. Next, business model should hold to collect and sell. Cash flows characteristic SPPI, or example given debt instrument. Is classification of this is the PFS mandatory. Next, the business model not defined cash flow characteristic. Not defined. Example given for this is the held for trading securities and equity. Yung mga na-discuss ko nga kanina. So, fair value through profit or loss. Next is the exemptions. First is the investment in equity securities or the FIBOC elections. Next, number 2, eliminates or significantly reduces accounting mismatch. The classification for this is the FVPL or the fair value through profit or loss designated. Okay. What is the difference between the equity instruments and the debt instruments? Equity instruments, it is an evidences a residual interest. Let's talk about the residual interest in the net assets of an entity. Example given is share of stocks. Number 2. Next is debt instruments. What is debt instruments? It represents a debtor-creditor relationship. Lending transactions, or example given is bonds. That's the difference. Next, we'll go now talk about the business model. A business model refers to how an entity manages its financial assets in order to generate cash flows. That is whether to A, hold financial assets in order to collect the contractual cash flows over the life of the instrument hold to collect. Yun nga, katulad ng sabi ko kanina, business model should hold to collect the contractual cash flow of the financial assets or liability. Okay, letter B. Business model should hold financial assets to collect the contractual cash flows but also sell them to realize fair value gains whenever an opportunity arises. So, yun nga nasabi ko din. Ang business model, syempre, it is for hold to collect and also to sell para makita yung para malaman yung value ng gains o kita whenever opportunity arises. This is hold to collect and sell. So, a business model, what is a business model nga ba? A business model is a matter of fact that is observable through the entity's activities rather than merely an assertion. A business model is determined by the entity key, management personnel, and does not depend on management intentions for an individual instrument. Yeah. So, in this business model, an entity business models for managing financial assets is normally codified in the entity's risk management manual, which includes among others the entity's approach to managing risk related to financial assets. The Bangko Sentral ng Pilipinas or BSP requires banks to have formal codification of their risk management policies. Okay, we will go now to the part of business model. First, hold to collect business model. Under this model, financial assets are managed to realize cash flows by collecting payments over the life of the instrument. An entity considers the following factors when determining whether cash flows will be generated through collections. A frequency, value, and timing of sales in prior periods. Letter B, the reasons for those sales, and also letter C, expectations about future sales activity. Next, a hold to collect business model is appropriate even when some sales occur or are expected to occur in the future. For example, this business model remains appropriate under the following circumstances. A, sales of financial assets because of increase in credit risk. Letter B, sales of financial assets with insignificant value even when such sales are frequent. And C, sales of financial assets that are infrequent even when the sales have significant value. And letter D, Sales made close to the maturity when the sale proceeds approximate the collection of the remaining contractual cash flows. Okay, we will go now to hold to collect and sell business model. Okay, this model is applicable when both collecting contractual cash flows and selling financial assets are integral to achieving the entity's objective of holding financial asset of that. Compared to hold to collect business model, this model will typically involve greater frequency and value of sales. This because selling financial assets is integral to achieving the business model objective rather than only incidental to it. There's hold for the frequency of value of sales that can or must occur in business model. Okay. In this hold to collect and sell may be appropriate when the entity objective is A. To manage everyday liquidity needs, B. To maintain a particular interest yield profile, or letter C. To match the duration of the financial assets to the duration of liabilities that those assets are funding. Okay, we'll go now to the other business model. Financial assets that is not held under a hold to collect or hold to collect and sell business model is measured at FVPL, or the fair value through profit or loss. This is case for the following. Mame-measured siya through this following. A debt instrument that is neither held under a hold to collect nor a hold to collect and sell business model. B. An equity instrument that the entity does not elect to classify as fair value of another comprehensive income. And letter C. An equity or debt instrument that meets the definition of held for trading security. Okay. Kanina pa natin syempre narinig yung held for trading security. Ano nga bang held trading for security? Trading security. A held for trading security is a financial asset that is A. Acquired principally for purpose of selling it in the near term. B. Part of a portfolio of financial instruments that are managed together and for which there is evidence of a recent actual pattern of short-term profit taking. Or letter C, a derivative except for a derivative that is financial guarantee, contract, or designated and effective hedging instrument. Okay. In this financial guarantee, contract is a contract that requires the issuer to make specified payments to reimburse the holder for a loss it incurs. Because a specified debtor fails to make payment when due in accordance with the original or modified terms of a debt instruments. Okay. As well, yung mga na-discuss natin, take notes of this. Only debt instruments can be classified under amortized cost or FVOC, or the fair value through other comprehensive income mandatory measurement categories. Okay. The debt instruments. Next, equity instruments are measured at FVPL, or fair value through profit or loss, unless the entity makes an irrecoverable election and initial recognition to measure them at FVOC election. Next, the third one is debt instruments that are not measured at amortized cost or at FVOC are measured at FVPL, or the fair value through profit or loss. Okay, sabi nga dito, yung debt instruments is classified under the amortized cost and the fair value through other comprehensive income. Kapag naman equity instruments, measured at the fair value through profit or loss. Kapag naman yung debt instrument is not measured at amortized cost or the fair value through other comprehensive income, it will measure at fair value through profit or loss. We will go now to the contractual cash flow. characteristic. Financial assets are classified as either amortized cost or Pfrs, depending on the business model. If their contractual terms give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding SPPI, so financial assets that do not qualify under this solely payments of principal interest or SPPI test are classified as fair value through profit or loss. So, PFRS 9 provides the following definitions for purposes of applying the solely payments of principal and interest. First one, the principal. Principal is the fair value of the financial assets at initial recognition and that it may change over the life of the financial assets. Example given, if there are repayments of principal. So, we have an example there for principal. For example, entity A acquires bonds with a face amount of 1 million for 900,000. So, the principal is the 900,000 because from the point of view of an entity A, the principal is 900,000. Notice that the principal is not necessarily the contractual face amount of the financial asset. So, ayun nga daw yun. Ang principal is yung 900,000. Dahil ay hindi daw yun ang face amount ng financial assets ni entity A. Okay, interest. Interest is the consideration for the time value of money for the credit risk associated with the principal amount outstanding during a particular period of time and for other basic lending risk and costs as well as a profit margin. Okay, take note of this. The business model and the solely payment of principal and interest test are relevant only to debt instruments. So, sa debt instruments lang siya. Hindi siya pwede sa equity instruments. Dahil nga, ang equity instruments daw is do not qualify under the solely payments of principal and interest test because they do not have contractual cash flows that are solely payments of principal and interest. So, equity instruments, therefore, are classified as fair value through profit or loss unless they are irrevocably elected to be classified as fair value through other comprehensive income or Pfrs. And that's all. Thank you.
Let's continue the discussion for Pfrs 9, and I'll begin with the summary of classification of financial assets. And as mentioned earlier, financial assets are classified at 3, at amortized cost, at fair value through other comprehensive income, and at fair value through profit or loss. So, yung mga assets na classified at amortized cost, sila yung mga nagdaan at nakapasa sa test for being solely payment of principal and interest. And dumaan din sila sa business model test and they are categorized as hold to collect. So they are the assets that are held by the business for collection of contractual cash flows without the intention of selling them until their maturity. And last but not least is the assets that are classified at fair value through profit or loss. So, they belong to the residual category since this kind of assets are acquired by the business para ibenta. Proceeds the measurement of financial assets. So, financial assets are initially measured at their fair value kasama lahat ng transaction costs. So, what are transaction costs? These are incremental costs or additional costs that occur during the issue or the acquisition and the disposal of financial assets or liability. So, hindi siya mag-occur if the entity did not issue, acquire, or dispose any financial instrument. And isa pa is If the assets are classified as fair value through profit or loss, transaction costs are not capitalized by the entity. So, hindi nila kinoconsider na part siya ng capital expenditures ng business. Instead, it is directly deducted to their revenue in the income statement. Take note that the fair value of financial asset will be its transaction price. So, kung magkano yung kabuoang nagastos ng business during the transaction, siya yung ilalagay natin sa initial recognition. And let's proceed sa subsequent measurement of financial assets, which can be measured at 3. At amortized cost, at fair value through other comprehensive income, and at fair value through profit or loss. And an asset that is measured at fair value through profit or loss, its gain and losses are directed to the profit or loss, and the remeasured fair value with changes are also directed to profit or loss. So, yun lahat ng nagbabago, lahat ng pagbabago or yung additional or yung profit and yung loss is lahat siya inire-record or ina-account sa profit or loss. And then next is fair value through other comprehensive income, mandatory. So, yung mga financial assets na mini-measure mandatorily sa fair value through other comprehensive income will be recognized directly sa OCI. And pag na-recognize sila, yung mga gains and losses will be recognized sa profit or loss na. And including the interest, ang interest na na-calculate will be recognized na din sa profit or loss. And next is the fair value through other comprehensive income election. So, yung gains and losses ng financial assets which are elected to be measured at fair value through other comprehensive income, except yung mga impairment and foreign exchange gains or losses, will be directed sa other comprehensive income or the OCI. And once de-recognize, hindi siya itatransfer ng entity sa profit or loss. But the entity may transfer them to the equity, or for example is the retained earnings, and the dividends that will be received by the entity are recognized at profit or loss. And next is the financial asset measured at amortized cost. The gains and losses will be recognized at profit or loss. Take note that the changes in fair value will not be recognized. Amortized cost. So, yung amortized cost is the amount of money at which the financial asset or liability is measured at the initial recognition. So, dito is deducted na yung principal amount of money na ibinayad natin para sa ating mga binarrow or niloan. And kasama na din dito or ima-minus or ipa-plus yung lahat ng expense ng amortization na na-charge sa asset na meron tayo. Using the interest method of any difference between the initial amount and the maturity amount, and for financial assets, adjusted for any loss allowance. So, let's proceed sa reclassification of financial assets. Dito, sasagutin natin yung tatlong tanong. Una ay, why do businesses reclassify? Pangalawa ay, when is the reclassification date? At pangatlo ay, how to reclassify? So, sagutin natin yung mga tanong. Una is, the entity reclassifies their asset when the changes in business model occurs for managing their financial assets. And the application of the business model is the first day of the first reporting period when they first apply the changes. And the business reclassify prospectively on the reporting date. So when the financial assets are reclassified by the entity, they are remeasured to their fair value. Gains or losses or any changes in the difference between the previous carrying amount and the fair value of the financial asset will be directly recognized sa profit or loss once reclassified. And if ang fair value natin during the reclassification date ay mineasure natin at amortized cost, so ito na yung magsisilbi nating bagong carrying amount. Proceed sa impairment of financial assets. So PFRS 9 uses ECL model or the expected credit loss model for recognizing the impairment losses of debt type financial assets that are measured at amortized cost and FBOCI. Mandatory. But before we proceed in the latter discussion, let's define the following terms. First is the impairment. Impairment is the state of an asset having fair value less than its carrying amount. And next is the expected credit loss. So expected credit loss is the weighted average of the credit losses that with respective risk of default occurring as the weights. So now we have the three approaches required by ECL model. First approach is the simplified or lifetime expected approach. This is applied in trade receivables and contract assets without the need of identifying the increase in credit risk. And in this approach, we will be required to measure the lifetime expected loss. So what is lifetime expected loss? Lifetime expected loss is the expected credit loss in the lifetime of an asset or of a financial instrument. And the second is the change of lifetime expected loss approach. This is applied in the assets that are credit impaired at purchased origination. Third stage is the general or the three-stage approach. These are applied in to all the types of financial assets classified at amortized cost or FBOCI. We're enumerating the three approaches required by ECL model. Now we will be discussing the general approach, which is included in the three approaches. So under general approach, the entity must determine whether the financial asset is one of the three stages in order to determine both the amount of ECL recognized as well as its interest income should be recognized. In stage 1, it is where the credit risk is not increased significantly. So it is in the performing stage or performing phase. And entities are required to recognize a 12-month expected credit losses. And its interest income is required to be measured on gross carrying amount. And in stage 2, it is where the credit risk is significantly increased and an entity or the entities are required to recognize the lifetime expected credit loss and interest income will be recognized in gross carrying amount basis. And on stage 3, it is where the financial assets is credit impaired. So this is effectively the point where there has been incurred loss event. So nagkaroon na ng loss or impaired losses ang business model. So for the financial asset in stage 3, entities will continue to recognize lifetime expected credit losses and the interest income will be calculated in gross carrying amount of the financial asset less the ECL. The amount of loss allowance or the allowance for expected credit losses on financial asset shall reflect on the credit quality of the instrument as shown in the table above or as shown in the stages of the general approach. First is if the credit risk has not increased significantly since the initial recognition, or if the entity opts to apply the low credit risk expediency, the entity shall recognize an allowance equal to 12-month expected credit losses. So what is the 12-month expected credit losses? This is the portion of lifetime expected credit losses that represent the expected credit losses that result from default events on a financial instrument that are possible within 12 months after the reporting date. So, kanina pa nating binabanggit yung mga credit risks. Ano nga ba yung credit risk? So, credit risk is the risk to a financial instrument that one party will cause financial loss to other party due to the failure of discharging an obligation. So, due to failure of discharging obligation, maaari tayong magdulot ng risk of financial loss sa ating kapartido, di ba? So, yun pala yun, yung credit risk na tinatawag. And though, if the credit risk has increased significantly since the initial recognition, but there is no objective evidence of impairment, the entity shall recognize a loss allowance equal to lifetime expected credit loss. So, pag daw nag-increase, pagtingin ng entity ay nag-increase yung credit risk ng kanilang financial assets, so kailangan na nilang maglaan ng allowance for the credit losses, which is equal to the lifetime expected credit loss. And number 3, if the credit risk has increased significantly since initial recognition and there is an objective of evidence of impairment, the entity shall recognize loss allowance equal to expected credit losses. So, yon, same siya ng number 2. Ang kaibahan lang is may evidence, objective evidence of impairment. So, financial assets are derecognized when the contractual rights to the cash flows from the financial asset expire. Paano ba natin masasabing expire na yung contractual rights natin to cash flow? So, ito ay expire na kapag na-collect na natin yung ating cash or yung possible cash na pwede nating makolek ay nakuha na natin or na-cancel or naging uncollectible yung ating cash to receive because of loss events. And next is the financial assets are derecognized when they are transferred, and the transfer
qualifies for the financial assets derecognition.
Paano ba natin masasabing transferred na yung financial assets natin? So, masasabi natin if the entity already transferred the contractual rights to collect or to receive cash flows of the financial assets. So, pag nailipat na ng entity, yung nagmamay-aring entity sa ibang entity, yung karapatan nilang mag-receive ng cash or mag-collect ng cash from the financial assets. So, it means the assets are already transferred. And letter B, retains the contractual rights to receive the cash flows of financial asset but assumes an obligation to remit the collections to a recipient in an arrangement that meets all the conditions listed below. So, first is the entity is not obligated to pay the recipient unless it collects an equivalent amount from the original asset. And number 2 is the entity is prohibited from selling or pledging the original asset except as security in favor of the recipient. And number 3, the entity is obligated to remit collections to the eventual recipients without material delay. So, yun. Transferred pala yung asset pagka kahit hawak pa din noong entity na unang nagmay-ari yung contractual rights to receive cash flows. Pero dapat niyang bayaran yung recipient na may karapatan na din para mag-collect ng cash. Pero dapat kung magbabayad siya dun sa recipient, the entity must make sure that the amount is equivalent from the original asset. So, dapat equal yung amount ng original asset at nung ibibigay niyang amount sa recipient. And number 2, hindi pwedeng ibenta ng entity yung original asset or yung financial asset kung hindi agree or hindi approve ng recipient or nung bagong may-ari. And number 3 is the entity is obligated to remit collections eventual recipient with. So, dapat walang delay yung pag-remit niya ng collections to the eventual recipients. And in addition, the entity is prohibited from reinvesting the collections except the cash or the cash equivalents during the short period from the collection date to the required date of remittance. And any interest earned by the investment is also remitted to the recipient. Determining how the financial assets are transferred, let's evaluate the transfer of the following financial assets. So, in here, the entity may choose to transfer substantially all the risks and rewards of ownership of the financial asset. So, dito is pag nag-transfer yung owner, is binibigay niya ng buo lahat-lahat ng karapatan ng isang owner na mag-collect ng contractual cash flows para mula doon sa financial assets. And if that happens, the old owner or the old entity who owns the financial asset will recognize the financial asset and separately recognize it in the assets or liabilities, any rights and obligations that are created, and yung mga natira sa pag-transfer. And then second is the entity who retains substantially the rights, the rewards, all the risk and rewards of ownership of the financial assets. So, in here, the entity already transferred the financial asset. However, he or she still have the right to collect contractual cash flows from the financial asset. However, that old owner or the former owner will have to pay the new owner of the financial asset, which corresponds to the original amount or original price of the asset. And then third is the entity may neither transfer nor retain the risk and rewards of ownership of the financial assets. So, if this is the choice of the entity, if the entity has not retained the control for the financial asset, so yon, kagaya nung una, if lahat binigay nila or lahat tinransfer nila, lahat ng control sa financial asset, so recognize nila yung financial asset and nire-recognize nila yon separately sa assets and liabilities or of any rights and obligations that are created and na mga and retained or yung mga natira sa pag-transfer. And letter B is the entity has retained control. So, they still have the control. Just like in the second statement, the entity has the control or still has the right to collect contractual cash flows in it, but they have the obligation to pay to the new recipients of the contractual cash flow collection or the collection of cash. And if that is the case, the entity will continue to recognize the financial asset to the extent of its continuing involvement in the financial asset. So, yun nga, they still have the connection or the involvement with each other. Kasi, yung old owner have the obligation to pay the new recipient of the contractual cash flow collection. Let's begin with the discussion of the financial liabilities. All financial liabilities are classified as subsequently measured at amortized cost, except for the following. First is the financial liabilities under fair value, true profit or loss, and derivative liabilities. Example are the designate and the liabilities that are held for trading. And the second is the financial liabilities that arise when the transfer of financial asset does not qualify for the recognition. So if the asset is transferred but does not qualify for the recognition, so the entity will retain the control for the asset, and they will have to recognize obligation measured on the basis which reflects to the rights and obligation that the entity has retained. And the third is the financial guarantee contracts, and commitments that provide a loan at below market interest rate. So this kind of obligation is measured under the amount of loss allowance or the 12-month expected credit loss, like what we are talking about earlier in the financial assets. And also this must be measured at the higher of the amount initially recognized less when appropriate the cumulative amount of income recognized in accordance with the principle of Pfrs 50 for the revenue from contracts and with cost. Last but not least, the contingent consideration recognized by an acquirer in a business combination. So these are subsequently measured at fair value through profit or loss. And we must remember that the reclassification of financial liabilities after initial recognition is prohibited. We will proceed na sa measurement of financial liabilities. So, financial liabilities are initially measured at fair value less the transaction cost, except those that are under FBPL. If liabilities are classified as fair value through profit or loss, transaction costs are also expensed immediately, just like in the financial asset. What different here is what the transaction costs are diminished in the fair value of the financial asset. Subsequent measurement of financial liabilities. Financial liabilities that are classified at amortized cost are subsequently measured at amortized cost. So, if kagaya lang nung sa financial assets, if considered siya or classified siya as amortized cost, i-measure din siya subsequently as amortized cost. And if financial liabilities are classified as held for trading, so fair value changes will be recognized in the profit or loss. Same as sa financial assets lang din. Yung mga assets na held for trading, yung assets na inacquire ng business, and in the first place, ibebenta din nila are recognized in the profit or loss in the financial statement. And the financial liabilities that are designated at fair value through profit or loss are subsequently measured at the fair value with changes in fair values recognized as follows. So, the amount change in the fair value is presented in the OCI. So, yon yung changes sa fair value niya, yung changes, yung changes na nakuha niya sa credit risk ng liability is ipipresent sa other comprehensive income. And then the second is the remaining amount of change in fair value of the liability is presented in the profit or loss. So, yun lang. And dyan nagtatapos ang discussion natin sa Pfrs 9. And parang connected lang yung topics na financial assets and financial liabilities sa isa't isa. Kasi yung way of classification nila is just parang halos magkatulad na, and yung measurement nila is pareho na. May kaunti lang pagkakaiba, pero kitang-kita mo naman kung ano yun, 'di ba? So, ayun lang. Maraming salamat.
So the next topic is PFRS 10, or the Consolidated Financial Statements. And before I continue, let me introduce first myself. I am Julian Enversa from Group 5, and I am here to present the first half of Consolidated Financial Statements, or PFRS 10. So what is Consolidated Financial Statements? So it is a financial statement of a group in which the asset, liabilities, equity, income, expenses, and cash flows of a parent and its subsidiaries are presented as those of a single economic entity. So, lahat ng asset, liabilities, equity, income, expenses, and cash flows ng group or ng parent and its subsidiary ay kinoconsolidate or pinagsasama-sama dito. So, here are some terminologies na makikita natin sa PFRS 10. So, group, it consists of a parent and its subsidiary. So, parang ito yung general term na isang corporation na kasama lahat ng parent and subsidiary. So, parent is an entity that controls one or more entities. So, it controls small entities called subsidiaries. Parang sila yung, kung sa totoong buhay, sila yung parent, and the subsidiaries are yung mga anak. So, subsidiary is an entity that is controlled by another entity. So, yun nga, katulad ng sinabi ko, parang in real life, sila yung anak being controlled by the parent. So, the subsidiary is being controlled by parent. PFRS 3 deals with the accounting for a business combination at the acquisition date, while PFRS 10 deals with the preparation of consolidated financial statements after the business combination. So, PFRS 3 deals with the accounting for a business combination at its acquisition date, while the PFRS 10 naman is after the business combination, saka lang magpe-prepare ng consolidated financial statements. So, all parent entities are required to prepare consolidated financial statement, pero may exemption or exceptions para hindi na mag-prepare ng Conso FS ang parent. So, a parent is exempt from presenting consolidated financial statement if it is a subsidiary of another entity. So, if yung parent company na yon is subsidiary pa siya ng ibang entity, na bigyan natin ng term na grandparent, for example. So, the parent is subsidiary siya ng grandparent, and yung parent na yun is may subsidiary siya. So, hindi siya required na mag-prepare ng consolidated financial statement if meron pang mas mataas sa kanya, if may mas mataas, may mas parent pa sa kanya or yung grandparent ka. So, and all its other owners do not object to its non-presentation of consolidated financial statements. So, ayun nga, meron subsidiary siya ng isa pang entity, and dahil nga ang pagpe-prepare ng consolidated financial statements is magkakasama na isa lang sa buong group, kasama na ang parent or yung grandparent and subsidiaries, isa lang ang mag-prepare. So, if the owners do not object na hindi na mag-prepare ng financial statements yung parent, okay lang, as long na may isa na magpe-prepare or yung grandparent is magpe-prepare ng consolidated financial statements. So the next is, its debt or equity instruments are not traded in a public market or being processed for such purpose. So there's a great responsibility if the stocks are traded publicly. So malaking responsibility nila as they are serving for the public. So they are required to prepare Conso FS. But if hindi naman available yung stocks, or they are not trading for public market, kahit hindi na sila mag-prepare ng Conso FS is okay lang. So hindi na required as long na hindi sila nag-ooperate for public. So the next is, its ultimate or any intermediate parent produces consolidated financial statements that are available for public use and comply with Pfrs. So parang combination siya ng A and B. So yun nga, may mas parent pa sa kanya, may mas mataas na entity pa sa kanya, at sila yung magpe-prepare ng consolidated financial statements, and available na yung Conso FS na yun for public use and for the compliance of Pfrs. So hindi na sila required na mag-prepare pag may nag-prepare ng iba dun sa group. So yun. Next is control. Control is the basis for consolidation. Pfrs 10 requires an investor to determine whether a parent by assessing whether it controls the investee. So control, ito yung dito, the investor needs to determine kung yung parent ba ay may control sa isang investee. So may mga factors or may mga certain things na yun yung dun malalaman kung ang isang parent or isang investor ba ay may control over an investee. So matatalakay natin yun later. So only one entity is identified to have control over an investee. So isang entity lang ang pwedeng mag-control sa isang investee. So if two or more investors collectively control an investee, then none of the investors individually controls the investee. So dahil nga isa lang ang dapat na magkocontrol sa isang investee, isang entity lang or isang investor lang hindi mo siya matatawag na control or parang walang control yung entity na yon if may iba pang nagko-control dun sa investee na yon. So, mamaya may madidiscuss din na rights na related dito. So, next is control of an investee. An investor controls an investee when the investor is exposed or has rights to variable returns from the investee and has the ability to affect those returns through its power over the investee. So, meron daw control ng isang investor sa isang investee if meron siyang rights and meron siyang ability to affect the investee's return. So, control exists if the investor has all of the following. So, ito nga meron ngang parang basihan para masabi na ang isang investor ay may control over an investee. So, an investor must have power over the investee. So, para masabing nakokontrol niya or may control yung investor na yon sa isang investee, dapat may power siya, power over the investee. So, next is dapat meron siyang exposure or rights to have two variable returns from the investee. So, mamaya mas matatalakay natin to, mas matidiscuss natin to ng mas maayos. May separate discussion for this. So, next is ability to affect the returns through the use of power. So, next is power. An investor has a power over an investee when the investor has existing rights that give it the current ability to direct the investee's relevant activity. So, an investor can have a power when he has existing rights. Mamaya ma-discuss din natin yung different rights na dapat meron ng isang investor para masabing he has control over an investee. So, relevant activity. So, activities of the investee that significantly affect the investee's return. So, ito yung sinasabi dito na ang investor ay may power over the investee kung may current ability ang investor to direct the investee's relevant activity. So, one example of this relevant activity is selling and purchasing of services and goods. So, the investor's current ability to direct the investee's relevant activities is often evidenced by the investor's ability to establish and direct the investee's operating and financing policies. So, para daw masabi na may power or may current ability to direct the investee's relevant activity ang isang investor ay dapat he can establish and direct the operating and financing policies ng investees. So, here are some examples of decisions about relevant activities. So, establishing, operating, and capital decisions of the investee, including budgets. So, an investor has power over an investee if he can establish operating and capital decisions ng investee. Includes na nga dun yung budget na pwedeng so yung investor is pwedeng meron siyang influence dun sa mga directors kung ano yung gusto niyang amount na ibigay or yung dividend na ibigay for that year para sa mga investee. So, appointing and remunerating an investee's key management personnel or service providers and terminating their services or employment. So, kaya ng investors na mag-appoint or mag-terminate ng mga pwedeng employees or services na galing sa mga investees. So, power arises from rights and it may be obtained directly from voting rights conferred by shareholdings. So, ang power daw is pwede kang magkaroon ng power if meron kang yung rights, if meron kang existing rights, or pwede rin naman from the voting rights na galing sa mga shareholders. So, however, power may also arise from other sources such as contractual arrangements. Example of rights that either individually or in combination can give an investor power includes rights in the form of voting rights of an investee. So, ayan, pwede nga yung power is magmula sa voting rights. So, rights to appoint, reassign, or remove members of an investee's key management personnel who have the ability to direct relevant activity. So, magkakaroon siya ng right to appoint or magtanggal ng members dun sa members nung investee na yon. So, meron siyang power para pag sinabi niya halimbawa na pwedeng pwedeng tanggalin yung isang personnel na yon or isang member na yan ng investee. So, meron siyang right or power. So, next is right to appoint or remove another entity that directs the relevant activities. So, kung dito naman, entity yung pwede niyang i-appoint or tanggalin. So, may right siya para magtanggal or mag-appoint ng entities. So, next is right to direct the investee or to enter into or veto any changes to transactions for benefits of the investor, and other rights such as making decision rights specified in a management contract that give the holder the ability to direct the relevant activities. So, next is ito na nga yung mga examples of existing rights that that gives an investor the power over an investee. So, the administrative rights, unilateral rights, protective rights, substantive rights, and potential voting rights. So, administrative rights, when voting rights cannot have a significant effect on an investee's returns, such as when voting rights relate to administrative tasks only, and contractual arrangements determine the direction of the relevant activities. The investor needs to assess those contractual arrangements in order to determine whether it has rights sufficient to give it power over the investees. So, sabi dito, di ba nga ang power pwede mo siyang ma-obtain through voting rights, pero dito if yung voting rights na yun is related sa administrative tasks only, so yung investor kailangan niyang i-assess yung mga contractual arrangement para ma-determine niya kung sufficient ba yung rights niya para masabi na may power siya over the investee. So, unilateral rights, if two or more investors individually or unilaterally have the ability to direct different relevant activities, the investor that has the current ability to direct the activities that most significantly affect returns of the investee has power over the investee. So, ito nga yung sinasabi ko kanina na isa lang entity ang pwede mag-control sa isang investee. So, sinasabi dito, para malaman kung sino magkocontrol sa isang investee, kung sino yung mas malaki yung apekto sa returns ng investee sa investee's return, siya yung masasabi na may power over the investee. So, kung sino yung mas malaki, parang kung sino yung mas malaki yung ambag, siya yung pwedeng mag-control, siya yung may power dun sa investee na yon. So, protective rights. Protective rights are rights designed to protect the interests of the party holding those rights without giving that party power over the entity to which those rights relate. So, an investor can have power over an investee even if other entities have existing rights that can give them the current ability to participate in the direction of relevant activities. For example, when another entity has significant influence. So, ang isang investor ay pwedeng magkaroon pa rin ng power over an investee kahit na yung ibang investee ay meron ding existing rights. Ayun nga, example nga nun is yung if may significant influence sila, yung ibang investors, for example, is pwedeng makontrol din, may influence din sila to direct the relevant activities of an investee. So, meron pa rin silang power over dun sa investee na yon. However, an investor that holds only protective rights does not have the power over an investee and consequently does not control the investee. So, ayun nga, sabi na yung investor is pwede siyang meron siyang power of investee kahit na yung ibang investor ay meron din existing rights. Pero kung yung isang investor na yon na ay yung isang investor na yon ay protective rights lang yung meron, hindi siya masasabi na pwede siyang mag-control or may power siya dun sa isang investee. So, hindi mo masasabi na makokontrol mo ang isang investee na yun or may power ka over sa investee na yun kung protective rights lang yung meron ka. So, here are some examples of protective rights. One is a lender's right to restrict a borrower from undertaking the activities that could significantly change the credit risk of the borrower to detriment of the lender. So, yung lender, meron siyang right na parang pagbawalan yung borrower na from making activities na pwedeng makasama do sa borrower na magiging na maaapektuhan din yung lender. So, yung lender may right siya or pwede niyang pagbawalan yung borrower na yun or maging strict siya dun sa mga activities na pwedeng gawin ng borrower. So, next is the right of a party holding a non-controlling interest in an investee to approve capital expenditure greater than that required in the ordinary course of business or to approve the issue of equity or debt instrument. Next is the right of a lender to seize the asset of a borrower if the borrower fails to meet specified loan repayment conditions. So yung lender, meron siyang right na if ever hindi makabayad yung borrower, pwede niyang kunin or pwede niyang kunin yung assets nung borrower para yun yung maging kapalit nung loans na hindi nga nabayaran ng borrower. So next is substantive right. In assessing whether it has a power, an investor considers only substantive rights when the holder has the ability to exercise. So next is voting rights. The investor's ability to direct the relevant activities of an investee is normally obtained through voting or similar rights. So ayun nga, pwede siyang magka-power through voting ng mga shareholders or investee. So dito sa voting rights, may iba't ibang pwedeng kahinatnan yung mga boto na makukuha mo. So pwedeng power with a majority of voting rights. So an investor that holds more than half or 51% or more of the voting rights of an investee is presumed to have power over the investee except when this is clearly not the case. So, ayun nga, pwede kang magkaroon ng power kung halimbawa na more than half ang nakuha mong boto. Holding more than half of the voting rights results to power when the relevant activities are directed through majority vote. So, yung relevant activities nanggaling mismo sa karamihan ng boto o yung majority vote. So, next is the majority of the members of the governing body that directs the relevant activities are appointed through majority vote. So, if yung governing body ay nagmula din or yung karamihan dun sa mga members na yon ay nanggaling din or nagkaroon din ng power through majority vote. So, ito pa yung ibang pwedeng kahinatnan dun sa voting rights. So, majority of the voting rights but no power. So, hindi porket marami or more than half yung nakuha mong boto is pwede ka na lang magka-power. So, may mga exemptions din para magkaroon ka ng power kahit meron kang more than half na boto. So, an investor does not have power over an investee even if he holds more than half of the voting rights if the right to direct the investee's relevant activities is conferred to a third party who is not an agent of the investor. So, kung halimbawa na so if yung right to direct the investee's relevant activities is from a third party, hindi siya agent ng investor. For example, is the investee's relevant activities are subject to direction by a government, court, administrator, receiver, liquidator, or regulator. So, if yung relevant activities na yun is para sa yung mga government, hindi not for the investee. So, next is the investors' voting rights are not substantive. So, if yung voting rights ng mga investors ay not substantive or hindi totoo ganun. So, next is power without a majority of the voting rights. So, dito, kahit hindi more than half yung nakuha mong vote, pwede ka pa rin magkaroon ng power. So, an investor can have power even if he holds less than a majority of voting rights of an investee. For example, through a contractual arrangement between the investor and other vote holders. So, if may contractual arrangement yung investor and yung ibang holders. Next is rights arising from the contractual arrangements. So, katulad nung sa administrative rights, if hindi pwede yung voting rights or related siya sa administrative rights, pwedeng manggaling yung power sa contractual arrangements. So, next is the investors' voting rights and the potential voting rights. And last is combination ng contractual arrangement between investor and other vote holders and yung potential voting rights. So, contractual arrangement with other holders. A contractual arrangement between an investor and other vote holders can give the investor power if the contractual arrangement gives the investor one is the right to exercise the voting rights of other vote holders sufficient to give the investor power. So, if yung voting rights ng ibang holders ay sufficient para mabigyan ng power yung isang investor din. So, next is the right to direct how other vote holders to enable the investor to make decisions about relevant activities. So, next is potential voting rights. An investor with current ability to direct the relevant activities has power even if its rights to direct have yet to be exercised or potential pa lang siya, hindi pa kahit hindi pa or yet to be exercised meron pa rin siyang power. Accordingly, when assessing whether it controls an investee, a parent shall consider potential voting rights that are currently exercisable irrespective of management intentions or financial ability to exercise them. Potential voting rights include share warrants, share call options, debt or equity instruments that are convertible into ordinary shares or other similar instrument that, if exercised, have the potential to give the entity voting power or reduce another party's voting power over an investee. Potential voting rights are not currently exercisable if they cannot be exercised until a future date or until the occurrence of a future event. However, during consolidation, non-controlling interests are determined on the basis of present ownership interest and do not reflect the effect of potential voting rights. Potential voting rights are considered only for purpose of determining the existence of control, which in turn determines whether an investee should be consolidated. So next is substantive removal and other rights held by other parties. So, substantive removal and other rights held by other parties may affect the decision maker's ability to direct the relevant activities of an investee. So, pwedeng maapektuhan yung decision maker's ability to direct the relevant activities of an investee. So, removal rights are rights to deprive the decision maker of its decision making authority. So, pwedeng mabago or maka-influence dun sa decision makers ability to direct the relevant activities of an investee. So, such rights are considered when evaluating whether the decision maker is a principal or an agent for other parties. An investor acting as an agent does not control an investee. For example, a decision maker that is required to obtain approval from a small number of other parties for its action is generally an agent. So, next is exposure or rights to variable returns. So, ito na nga yung explanation dun sa um, control exists if an investor has exposure or rights to variable returns. So, an investor is exposed or has rights to variable returns if its returns from its involvement with the investee vary depending on the investee's performance. If yung involvement ng investor sa investee ay nakadepende or yung return ay nakadepende sa investee's performance. So next is ability to use power to affect investors' returns. The investor's ability to use its power to affect its returns from its involvement with the investee provides the link between power and variable returns. Only if this ability is present along with the power and exposure or right to variable returns does the investor obtain over the investee. So, yung ability daw ng investor to use power to affect the returns from its involvement is parang pinagko-connect niya yung power and variable returns. So, dito sa next slide, makikita natin yung elements ng control. So, dito makikita na yung power and variable returns and control. Power and variable returns connects dun sa ability to affect returns, and if if an investor has a power and ability to affect returns or has variable returns, so it means may control yung investor. Or so if yung power at variable returns is kumbaga present siya sa isang investor, doon mo masasabi na may control siya sa investee. So next is accounting requirements. So consolidated financial statements shall be prepared using uniform accounting policies. So dahil nga ang consolidated financial statements ay isa lang sa buong group, so dapat isa lang din yung accounting policies na gagamitin nila. So kahit pa for example is ang parent niya ay from ibang country, tapos ang subsidiary niya ay dito sa Pilipinas, kailangan same sila ng accounting policies. So dapat isa lang yung ginagamit nila. And so next is the financial statements of the parents and subsidiaries used in preparing consolidated financial statements shall have the same reporting dates. So diba nga dapat uniform accounting policies ang ginagamit nila or pareho. So dapat pareho din yung reporting dates nila. So if a parent and the subsidiary's reporting periods do not coincide, the subsidiary shall prepare financial statements that coincide with the parent's reporting period before consolidation. So dapat kung hindi man magtugma or hindi pareho yung financial statements nila, dapat kumbaga parang kailangang mag-adjust yung subsidiary para maging same sila ng reporting dates. So if this is impracticable, the subsidiary's financial statements shall be adjusted for significant transactions and events that occur between the end of the subsidiary reporting period and that of the parents. The difference of the parents and subsidiaries end of reporting period shall not exceed 3 months. So, yun nga kailangang i-adjust. So, and if kung meron man talaga na hindi talaga sila same, may maximum difference dapat. So, 3 months lang dapat yung hanggang 3 months lang yung hindi nila yung difference dun sa reporting period nila. So uniform accounting policies shall be used. If the subsidiary uses different accounting policy, its financial statements need to be adjusted to conform to the parent's accounting policies before they are consolidated. So if magkakaiba sila ng ginamit or yung subsidiary ay iba sa ginamit ng parent, kailangang i-adjust or isalin or ilipat dun sa katulad na accounting policies na ginamit ng parent para maging same sila. So consolidation begins from the date the investor obtains control of the investee. So nagsisimula daw yung consolidation or yung pagpe-prepare ng consolidation financial statements from the date the investor obtains control. So pag nagkaroon na ng control ang investor dun sa investee, and it ceases when the investor loses control of the investor. So kung wala ng control ang isang entity sa isang investee, so doon na rin mag-stop yung pag-prepare ng consolidated financial statement. So here's an example. So if an investor obtains control of an investee on July 1, 20x1, the group's consolidated financial statements for the year ended December 31 shall include only the investee's result of operations from July 1 to December 31. So, kung nagsimula daw kung na-obtain yung control ng investor over an investee ng July, so yung pagpe-prepare ng consolidated financial statements ay magsisimula lang from July 1 or kung kailan na-obtain yung control up to the end of the year or December 31. On the other hand, if a parent loses control over its subsidiary on September 30, the group's consolidated financial statements shall include only the investee's result of operations from January 1 to September 30. So, kung nawala na ng control ang investor do sa investee, matitigil na rin yung pag-prepare. For example, ayun nga, kung natigil yung or nawala ng control ang investor dun sa investee nung September 30, so ang consolidated financial statements niya is starting from January 1 up to the end nung kung kailan nawala yung control, so yung September 30. So, the continuation will be reported by Mr. Janela.
The continuation of discussion for PFRS 10. So now we are already in the measurement of consolidated financial statement. So the measurement for the consolidated financial statement is pag nagkaroon ng business combination. So lahat ng transactions are recognized separately pag ng parent and subsidiary. So, nire-record yon ng parent and subsidiary in separate accounts. Pero pagdating na ng reporting date ay nagiging yung end of the period, nagiging consolidated na yung pag-recognize nila ng bawat transaction. And here we have the income and expense. So, ang income and expense is nire-recognize or mine-measure ang amount ng assets and liability based sa acquisition date. And example is yung depreciation expense is nire-recognize siya sa kanyang acquisition date rather than dun sa carrying amount, kahit na nasabi nating yung asset is depreciated na, 'di ba? And next is the investment in subsidiary. So pagdating sa investment in subsidiary ay yung measurements dito ay in separate account pagdating sa parent and subsidiary. So, ikino-combine ang transaction at information sa pagdating na ng consolidation date. So, next naman is measurement at cost. So, an asset or liability is measured at cost based on the value considered on the acquisition date. Pero, nagbabago to kapag nai-impair na yung asset. Kasi pag na-impair na yung asset, 'di ba, nag-i-incur na or nakaka-experience ng losses yung company. And next naman is measurement in accordance with PFRS 9. So, dito, same lang siya sa measurement at cost na yung value na kino-consider is at the acquisition date. Pero ang pagdating ng subsequent measurement is mine-measure na siya under fair value. And next is measurement using equity method. So, base dito is same lang siya sa measurement at cost. So, pag na-measure na siya under sa value ng assigned during the acquisition date, ang pinagkaiba lang nila is pag nag-subsequent measurement na is mine-measure na siya sa increase and decrease sa share ng bawat investor under investees equity. Next is the non-controlling interest. So, ano nga ba yung non-controlling interest? So, ito ay nag-e-exist kung hindi buong inacquire nung investor or nung parent yung ownership ng sa business. So, nawawala yung controlling hindi nag-e-exist yung non-controlling interest kung buong inacquire ng parent yung ownership ng business. So, yung non-controlling interest is yung natitirang parte na hindi nabili ng parent ay wala silang control doon kasi nga hindi nila pag-aari yon. Controlling interest in net assets of the subsidiary. So, yung NCI ay mayroon silang separate line items. So, may iba't iba silang linya or categorization of items. So, kagaya din ng iba. Diba? So, yung NCI in net assets of subsidiary are consisted of amount determined at the acquisition date and net non-controlling interest shares of changes in equity. So, yun. And ang next naman is non-controlling interest in profit or loss. So, sa non-controlling interest in profit or loss and comprehensive income, lahat ng profit or loss and lahat ng component nito ay attributed sa parent, subsidiary, and the non-controlling interest. So, dito, yung income or yung profit or loss na nakuha ng entity is dinidistribute or pinamamahagi dun sa bawat parte ng entity such as the parent, the subsidiary, and the non-controlling interest. And next naman, proceed tayo sa preparing of consolidated financial statements. So, ang preparation ng consolidated financial statements are by combining the financial statements of the parent and the subsidiaries line by line by adding together the similar items of assets, liabilities, equity, income, and expenses. So, sa pag-prepare nito, i-a-add yung asset ng parent at ng subsidiary, liability ng parent at subsidiary, equity ng parent at subsidiary. Pero, kung titingnan natin, parang napakadali lang, pero merong complexity. Kasi, hindi lamang umiikot sa parent at sa subsidiary yung mga transactions. Maaari yung subsidiary is nakipag-transact sa outside party. And yon. Naman tayo sa consolidation subsequent to the acquisition date. So, yung process na to is sinusunod lang niya yung same procedures ng consolidation at the acquisition date. Pero yung pinagkaiba niya is isinasama na dito yung mga subsidiary na net assets ng subsidiary, yung mga changes sa subsidiary ng net assets. Kasi kinonsider na natin dito yung acquisition date. So, yon, proceed na tayo. Sabi nila, mahirap daw yung topic, pero kung madali lang siya kasi procedural siya. So, parang may sinusunod ka lang na process. So, proceed tayo sa consolidation date at acquisition. So, the consolidation procedures at the acquisition date are simple in the sense that only the statements of financial position of the combining constituents, the parent and the subsidiary, are consolidated. So, pinagsasama yung financial statements or the statement of financial position ng parent and subsidiary. And this involve the following steps. So, ito yung mga steps kung paano makuha yung paano ma-solve itong consolidated financial statements. So, number 1 is to eliminate the investment in subsidiary account. So, ang requirements dito is to measure the identifiable assets acquired and the liabilities assumed in the business combination at their acquisition date. And next is here we have to recognize the goodwill from the business recognition. And third is to eliminate the subsidiaries pre-combination equity accounts and replace them with the non-controlling interest. Dito may given tayo. Ang illustration natin dito is the financial statements of the parent and subsidiary and its subsidiary, the acquisition date are shown below. So, given is the cash of the parent is 10,000 and the cash of the subsidiary is 5,000. And the accounts receivable are of the parent and subsidiary respectively is 30,000 and 12,000. And the inventory of the parent and subsidiary are 40,000 and 23,000 respectively. And the investment in subsidiary is 75,000 and the subsidiary doesn't have investment because the parent will invest on them. And then the equipment net value is 180 and 40,000 respectively for the parent and the subsidiary. And the total asset, if we add them all, total will be 335,000 for the parent and 80,000 for the subsidiary. And next is for the liabilities and equity. So accounts payable of the parent is 50,000 and 6,000 for the subsidiary. And the share capital of the parent is 170,000 and 50,000 for the subsidiary. And the share premium is 65,000 and the subsidiary is zero value. And then the retained earnings for this parent and subsidiary are 50,000 and 24,000 respectively. So the total liabilities, if we add them all, will be 335,000 for the parent and 80,000 for the subsidiary. And additional information. We have the additional information of that the subsidiaries assets and liabilities are stated at their acquisition date per values except for the following. So, ito ang exception dito are the inventory which is amount which has the amount of 31,000 and the equipment with a net value of 48,000. And second information is the goodwill determined under PFRS is 3,000 and the NCI in the net assets of the subsidiary also determined under PFRS 3 is 18,000 pesos. So, what we need to do here is to prepare a consolidated statement of financial position. So, first, we have to follow the step 1. So, again, the step 1 is to eliminate the investment in subsidiary account. And what we must consider measuring the subsidiary's asset and liabilities. So, dito, ineliminate natin yung investment in subsidiary. So, inalis natin yung 75,000 na investment in subsidiary ng parent entity. And then the step 2 is the step 1A. So, those that are required in step 1 is to measure the assets and liabilities at their acquisition date, fair values. So, yung mineasure natin yung subsidiaries assets and liabilities. And step 1B or the second requirement for step 1 is to recognize the goodwill. So, we added the goodwill in the list in the line of the items. And then the step 1C or the third requirements for step 1 is to replace the subsidiaries pre-combination equity accounts with NCI in net assets. So, yon, instead na isama natin yung share in capital and retained earnings, kinonsider na natin dito yung additional information na NCI in net assets na 18,000 pesos. Our step 2 will be to add the similar items line by line, the assets and the liabilities of the combining constituents. So, yon, 'di ba? Nagawa na natin yung step 1. So, yung nakuha nating list of items from step 1 is yun yung gagamitin natin sa step 2. And dito is i-consolidate na natin yung accounts of the parent and subsidiary. So, ang nangyari dito is yung cash ng parent and subsidiary pinag-add. So, naging 15,000. And same as the account receivable na naging 42,000 and the inventory na naging 71,000. So, dinisregard na natin yung investment in subsidiary. And proceed na tayo sa equipment with a net value of 180,000 and 48,000 with a total of with the consolidated total of 228,000, and the goodwill. So we consider the goodwill from the additional information, which is 3,000. So the total assets, if we add them all, is 359,000. And then for our liabilities and equity, the accounts payable of the parent is 650,000, and the subsidiary has 6,000 liabilities. Account payable, which is total of which has the total of 56,000, and the share capital of the parent is 170,000, so the consolidated will be 170,000 since the subsidiary doesn't have a share capital, and the share premium will be 65,000, and the consolidated will be 65,000 since the subsidiary doesn't have share premium as well, and the retained earnings will be 50,000, and the total for the consolidated amount will be 50,000 since we disregard we replace the subsidiary's pre-combination equity of 50,000 and 24,000, and then the non-controlling interest in net assets will be 18,000, and the consolidated amount will be 18,000 since it we like what I've said in step 1C, we replace the subsidiary's pre-combination equity with the net assets in with the non-controlling interest in net assets. So the total of the equities and the liabilities and equities will be 359,000. So yun lang, madali lang yung process ng measurement and consolidation of financial statements in PFRS 10 kasi parang nag-a-add-add ka lang and may pinapalo tayong procedures. Pero, tandaan natin na hindi lamang sa parent and subsidiary umiikot yung transaction. So, posible tayong makaranas ng complexities. So, yun lang, and this will be the end of PFRS 10.
PFRS 11, Joint Arrangement. What is joint arrangement? An arrangement of which two or more parties have joint control. There are two essential elements in the definition of joint arrangement. The first one is contractual arrangement. Distinguishes interest in joint arrangement from other investments. The second one is joint control, the contractually agreed sharing of control of an arrangement. Contrast joint control with the following. Significant influence is the power to participate in the financial and operating policy decisions of an investee but is not control or joint control over those policies. Control is the power to govern the financial and operating policies of an investee so as to obtain benefits from it. Types of joint arrangement. First one is joint operation. The parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. Those parties are called joint operators. Letter B, joint venture. The parties that have joint control of the arrangement have rights to the net assets of the arrangement. Those parties are called joint venturers. An entity applies judgment when determining the type of joint arrangement in which it is involved by A. Considering its rights and obligations arising from the arrangement. B. Assessing its rights and obligations in relation to the structure and legal form of the arrangement, terms of the contractual agreement, and other facts and circumstances. Rights and obligations arising from the arrangement. Letter A. If the contractual arrangement confers to the parties that have joint control rights to the assets and obligations for the liabilities of the joint arrangement. The joint arrangement is a joint operation. The parties that have joint control are referred to as joint operators. Letter B. If the contractual arrangement confers to the parties that have joint control rights to the net assets of the joint arrangement, the joint arrangement is a joint venture. The parties that have joint control are referred to as joint venturers. Assessments of rights and obligations, structure and legal form of the arrangement. A joint arrangement that is not structured through a separate vehicle is a joint operation. A joint arrangement in which the assets and liabilities relating to the arrangement are held in a separate vehicle can be either a joint venture or a joint operation. Separate vehicle, a separately identifiable financial structure. Remember the following: joint operation, rights to and obligation is for assets and liabilities. Joint venture, rights to is for equity. Joint operation. A joint operation recognizes its own assets, liabilities, income, and expense, plus its share in the joint operation assets, liabilities, income, and expenses. These items are accounted for under Pfrs applicable to the particular assets, liabilities, income, and expense. For the example, illustration 1, entity A and entity B agreed to combine their operations, resources, and expertise to manufacture, market, and distribute jointly a particular product. The joint arrangement qualifies as a joint operation. Different parts of the manufacturing process are carried out by each of the joint operators. Each joint operator bears its own cost and share equally on the revenue from the sale of the product. The joint operation was completed and thus terminated during the year. The following were the transactions. Entity A incurred total cost of 100, assumed obligations amounting to 20, and made sales amounting to 200. Entity B incurred total cost of 80 and made sales amounting to 150. Financial reporting. The individual statements of comprehensive income of the entities will show the following. Entity A, sales 200 plus 150 times 50%, 175. Expenses 100. Profit 75. Entity B, sales 200 plus 150 times 50%, 175. Expenses 80. Profit 95. Interest in joint operation whose activity constitutes a business. When an entity acquires an interest in a joint operation whose activity constitutes a business, it shall account for each share as a business combination. Accordingly, the entity shall apply the following principles of business combination. Pabasa na lang po letter A to E. Then, may 2 slides na lang po, so pabasa na lang po. That's all. Thank you.